Okay, finally, the comprehensive problem where we have a company with a capital structure of 35% debt and 65% common equity, and they want to maintain this capital structure. And net income is going to be 1.2 million. They have 40,000 shares of common stock outstanding. Their firm's tax rate is 40%. Their loan amount up to 750,000 is 10%. After that, it's 12%. So the market price per share is $50. They're going to pay a 5% dividend. The company's expected growth is 9%, and the flotation cost for a new common stock is 8%. And they're looking at several investment options, projects A, B, C, and D, and they want you to figure out which ones they should do. Okay, so let's just step through this. This is not as scary as it looks. Let's just start at the beginning here. And the first thing we want to do is calculate the cost of debt and equity. So before cost of debt is before tax cost of debt below 750,000 is 10%. Marginal tax rate is 40. And I'm getting this from, and I know I read through that quickly, but I'm getting this from right here, right? So, and then our before tax cost of debt over 750 is 12%. Marginal tax rate is the same. So we have a after tax cost of debt after 750,000 of 7.2, which is slightly higher than 6% at the which is any amounts 750,000 and below. Okay, the expected dividend per share was, now I forgot what it was. Let me go back. $5. Let's see, 9% growth in $50 per share. Okay, so we need to put that in here. These are the variables that you need for the cost of common stock equity. Current price per share 50, and expected growth rate, was it 9%? I think it was, yeah, 9%. Expected growth rate 9%, yeah. So that's going to be our common cost of common equity. Expected, now we need to get a new common stock, which is going to be the same dividend per share, current price per share, expected growth rate 9%. And this formula right here is just because it's a percentage. It was 8% of C59, which is the share. So the flotation cost, I had to put a formula in here to get 8%. See up here, 8% of the current price of the stock, and that gives us a dollar amount of $4 for your flotation cost, and that gives us a slightly higher cost of new common stock equity. Now we need to get our breakpoint. So our percentage of equity, I believe, was 35%, but I'll check on that. 35% debt. No, 65% equity. Whoa, okay. So equity is 65%. So you want to get that right. 65%. Let's see. 65. Shares outstanding, I believe, was 40,000. Yeah. Dividend paid was 5. And expected net income was 1.2. Let's see, 000, right? That's our, because that's what they said right here. If you go back and look, they were expecting a net income of $1.2 million, but they're paying a dividend. So I had to put that in the formula right here to take out the dividend of $5 per share. So I'm multiplying 5 times 40,000 and subtracting that from the expected net income, and that gives us the dollar amount, a limit for equity of 1 million. And since it's that has to be 65% of their total capital, so their equity breakpoint. So 1 million is 65% of 1.538 million, which gives us in 35% of the total. Well, if this is our total, then the debt is going to be 35% of that, and you see my formula, which gives us a debt of 538,000 in terms of our equity breakpoint. Now, debt breakpoint, we just put in 35%, and then we put in dollar amount limit, which was 750,000, and that's going to give us our first equity debt breakpoint of 2,142,000 and change, and then now we're done. Now that takes care of pretty much everything. Everything else fills in for you. I've got the formulas in here, and these formulas right here are just weighted average cost of capital formulas to figure out the weighted average cost of capital at each breakpoint. So the first breakpoint, we can see that the average cost of capital is 14.45%, and that's up to a little over 1.5 million, because this is in thousands right here. So that's right there. And then our second break point is going to be where we're between. See, if you look at this, the highest one is the 2 million one. Let me find it. Is the debt right here? The debt break point right here is going to be when we have the more expensive debt after $750,000. So that's going to be the highest one. So we're looking at before the equity break point right here, and then in between the equity break point and the break point for a debt right here, and then above the debt break point right here. And so you can see those break points in the graph: 14.45, 15.02, and 15.44. So this is the cost of our debt as we invest more and more money. Now, the important thing here is that these projects are cumulative. So you want to rank them in order of highest return to lowest return. So it's D, A, C, B. And then you want to look at the cumulative investment. So I put a just simple sum formulas in here, which adds these up as we go, because you're not looking at these projects in isolation. You're looking at them as a group. So you always want to do the ones that have the highest return first, and see if you can afford to do it. And obviously, with a return of 18% up here, project D, and a marginal cost of capital of 14.45%, then that's one you're going to want to do, because the return is much higher than the cost. And you can also see you're going to do project A as well, because even when you add project A, which is 500,000, to project D, you get a total investment of 2 million. The return for project A is 16%, so you're still earning 16% right here, and you're still above the marginal cost of capital at that point, which is 15.02. Now, once we get to project C, add that in, we're up to 2,600,000. The return for project C is expected to be lower, 15%, and even though we can start it, when we start right here, actually we're not at all. We're not. The cost is above even at the beginning, so we can't do project C at all, because its cost of 16%. No, I'm sorry. Its cost of 15% right here is higher, or is not cost. I'm talking in opposites. Its return of 15%, this brown dotted line, is lower than the cost of 15.02, and it's certainly lower than 15.44. And obviously we can't do project B, because at that point we're spending we're up over $3 million in our investments right here, up to $4,200,000, and the return is much lower than the cost of capital at that point. So we want to do projects D and A, not C, not B. Okay. Now I ask you to write that out in a narrative right here, explain that, and then I've asked you to talk about why it's important to use the marginal cost of capital and not the firm's initial weighted average cost to evaluate investments, and that's because these are cumulative. We're not looking at these in isolation. We're not saying, well, project C is only $600,000. We're looking at project C as an addition to project D and A, because we always want to do, once again, we always want to do the projects with the highest return first. So you see, that's why that answer is there. So you can use your own words here, but I want you to really think about this. I took the time to make this a graph right here so you guys could see visually what's going on with these marginal cost and these breakpoints. Okay, that is your cumulative problem. You have a problem in your quiz very much like this, that if you think about it, you'll do fine. I think I might make a short video just to give you a couple of pointers on the quiz, but you should be fine, and that does it for your homework.